This is the
taxes.
beauty, Buck. This is the beauty. The trust typically 99.9% of the time never pays any tax. And this is true for all of our trusts. Watch, you ready?
Yeah.
Because the trust can expense the interest on the note that it owes to Buck.
Welcome, everybody. This is Buck Jarvie with the Wealth Formula podcast coming to you from Montecito, California. And before I begin, want to remind you, if you are an accredited investor, make sure you go to wealthformula.com, sign up for our accredited investor club, and, see the potential opportunities coming down the pipeline. We are sort of in that, we're across the board. It's not just real estate and stuff, but unless you are invested in gold or Bitcoin, you've been dealing with a lot of assets that have been going downward with the American economy in question, with tariffs and all of that stuff. Markets have been selling off, the stocks, and real estate has been down for a long time. And anyway, if you want to take advantage of this market, I encourage you to do so. And one way you can do that is by going to wealthformula.com and signing up for the Accredited Investor Club, of course, assuming you are an accredited investor, and getting onboarded and seeing the potential opportunities coming down through that group. There is something that's been going on recently, great opportunity in the real estate space. If you are an accredited investor, make sure you check that out if you're already in the group. Anyway, that said, the last couple of weeks, we have been deep in the world of buying businesses. That's what we've been talking about. But what happens when it's time to sell, to cash out? Maybe you're a business owner already. Maybe you're thinking about, buying. Maybe you're thinking about selling that business, or maybe you've got an investment property, or maybe a bunch of Bitcoin, and you're starting to see this stuff go up again. And you say, this time I'm going to sell when it hits that number. If you're like most people, there is a thrill with the idea of the big sale and the potential profits ahead that are quickly overcome by the less exciting thought of, wait, how much am I going to pay in taxes if I do this? It's kind of like the classic 1-2 punch, right? Excitement followed by the agony of taxes. Anyway, but here's the good news. You have real options. There are real options out there if you are interested. Real, legal, IRS-approved options. And the right strategy could potentially mean the difference between watching your profit shrink and then maybe just putting your money somewhere else and letting it work for you there. Anyway, let's start with your oldest trick in the book. You've heard about it here many times, the 1031 exchange. If you own real estate and you're selling, the idea is simple. You sell your property, buy another like kind of property, and if you follow the rules, kick that tax bill down the road. It's something that's been used forever. And by the way, it's not just a real estate thing. You can absolutely use this on businesses as well if you like. Just keep in mind, one thing with 1031 exchanges, and this is going to come up with all of these, is it gets a little bit trickier when you have a mortgage, because you need to replace the debt as well with equal or greater debt on your on the next property that you buy, or you got to pony up the difference in cash. Otherwise, the IRS is going to want a piece of it. Now, maybe you're tired of being a landlord and you have seen that there are some properties, maybe even in things that are coming through the Accredited Investor Club, where you can use a 1031 exchange. That's actually pretty rare in the syndication space. However, we have seen them. There's another way you can do this, and it's something called a Delaware Statutory Trust, or DST. And that's essentially syndications, like real estate syndications are specifically designed for these kinds of exchanges. You sell your property and then you buy in sort of the shares of the new syndication. They're professionally managed, just like a syndication. It could be an apartment complex, could be a shopping center, could be a fund. Now, DSTs often come with their own loans again, so you can match your old mortgage and keep tax deferral going. The upside, of course, just like in any situation, you don't have to be a landlord anymore. You can let that heavy lifting go to an operator. The downside, of course, is you have to find a good operator. And, there's not that many really good operators that are doing DSTs. They're not as profitable sometimes as some of the other syndication opportunities that are available. And the other thing is there are some very, very strict rules that relate to Delaware statutory trust that make it sometimes very difficult to buy properties that are going to be very profitable. That said, I don't want to be super negative on this. I just never found anything that was compelling along that line. But in theory, it sounds like a really good opportunity. Okay, so what if you're selling a business? Well, employee stock ownership plans, ESOPs, basically sell your company to the people you help that helped you build it, your employees, and defer a big chunk of your capital tax in the process. Basically win-win. But if your business has debt, things get complicated fast, and this is definitely a strategy you will want a seasoned advisor, not somebody like me, to tell you more about. You've probably heard also about opportunity zones. I don't want to talk about those too much. Basically, again, a tax deferral mechanism. The problem with opportunity zones, in my view, has been that by the time that you have opportunity zones, the price of the opportunity zone has already been baked in. In other words, you're often overpaying for stuff because the operator knows that you are using this as a tax deferment tool. The other thing is, of course, by the nature of opportunity zones, they're often assets in areas that are not that great. And if that's the case, that makes it a little bit risky as well. Now, other things you could do, you could talk about installment sales or structured sales. Instead of getting paid all at once, basically, you spread out the payments and the taxes over several years. Structured sales, basically, you use a third party to guarantee those payments. And that adds a little layer of security. These are hard to do if you have a mortgage, by the way, because the IRS treats the amount the buyer pays off at the time of sale, in the debt, as if you got all that money in cash on day one. So that is a little trickier there. Now, similar to a structured sale, but maybe more supercharged, is what we're going to talk about today in more detail. It's a deferred sales trust. This is really interesting. I think it's worth talking about because instead of waiting on the buyer for payments like you do in that structured payment type thing that we talked about before, your money isn't just rotting somewhere and coming slowly. You transfer your asset to a trust before it is sold. It then sells it and invests the proceeds basically the way you want them invested. And then you can sort of do that payment plan that we talked about before. The advantage, again, now you get to choose how and when you receive the money. And the trust can invest in all kinds of assets while your taxes stay deferred. So flexible, powerful. Again, it gives you a chance to actually grow your money while you wait to receive it. Now, which of these strategies is right for your situation? Of course, depends on your goals, your assets, and whether you have debt on the property. But as always, the key is just knowing your options, right? That's what we're all about on this show, and working with someone who can guide you through the maze. And that said, for assets that have no debt, I really do think that this deferred sales trust is something to think about. And that's why we have an expert on that very topic on the show today. And we will have that interview right after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast has been on before. His name is Brett Swartz. He's a founder of Capital Gains Tax Solutions and a leading expert on deferred sales trusts. With over $500 million in closed transactions, Brett helps high net worth individuals defer capital gains taxes on the scale of highly appreciated assets. He's also the co-host, or the host rather, of the Capital Gains Tax Solutions podcast and the author of Building a Capital Gains Tax Exit Plan. Welcome to the show. How are you?
Buck, so good to be here. Thank you so much. Always love spending some time with you.
Yeah. Well, we were on before, and it's cool. You've got you had the book since then. You also had the podcast, so things sound like they are taking off, or they're doing very well. So good for you on that. We'll talk about that a little bit in a bit. I thought it would be a good time to just sort of, it's been a while to talk about some of these options when people exit businesses or, exit homes, exit Bitcoin, whatever. And a lot of people think about like-kind exchange, and they think about 1031 exchanges exclusively, but there are other options, and they may suit people better. Specifically, we want to talk today about what you specialize in, which is the deferred sales trust, which is, by the way, different from the other DST that people probably know, which is a Delaware statutory trust. You probably get that confusion quite a bit. Why don't you talk a little bit, like who would benefit from a deferred sales trust as opposed to a Delaware statutory trust or a 1031 exchange?
Yeah, we really serve the purpose-driven entrepreneur or investor, depending on what lifestyle they're in, but they want flexibility. So sometimes our clients we found, Buck, over the years are very entrepreneurial, but they want options to be able to make sense of when they invest. We've seen the stock market the last few weeks. It's been kind of brutal. We also saw Bitcoin run up before that, and now it's a little bit down. Real estate obviously is taking its hits these last couple of years with interest rates where they've gone. And so I think the strategic investor is kind of like, the concept of timing, right? I mean, if you can invest when it makes sense for you, when you have certainty of conviction for that asset class, you gain leverage. And so I say the purpose-driven entrepreneur because they're very intentional about their wealth, building of the wealth, the stewarding of the wealth, but they also want flexibility with how and where they invest the wealth. And so that's really the focus. And each plan is customized to the client. We can dive into deal stories for particular clients. They kind of bring this alive, but the key thing about the deferred sales trust is just so flexible. It can serve the person who wants to be passive, and it can also serve the person who wants to be active entrepreneur.
So let's dive a little bit into more details on that. So, for those who have don't know what 1031 exchange is, basically it's the biggest tool that typically is used for real estate, and it can be used in businesses as well, but most commonly you hear it in the context of real estate, and it allows people to essentially roll into other real estate that has greater value. It might be a portfolio, it may be whatnot, and not pay a capital gains tax. But again, in that situation, you are ultimately rolling into another real estate asset. So you do have that lack of flexibility if you want to do something else. In addition, one of the issues that often comes to play in those situations is in 1031 exchanges, you often end up buying, or people can end up buying assets that they would not otherwise buy. Because there is a period of time in which you have to make that decision. So, okay, so I want to talk a little bit about the specifics here, and I think I understand it. So I'm going to tell you how I think it works, and you correct me, okay, Brett? So with a deferred sales trust, first, you sell your asset technically to you sell your asset to the trust instead of directly to the buyer. So that's step one. Mm-hmm. Step two, the trust immediately sells to the actual buyer and receives the cash proceeds. The third part is that the trust reinvests those proceeds according to your plan. And next, you receive, if you wish, installment payments and defer paying taxes until the funds are actually received. And so the benefit from improved cash flow, reduced tax impact, and enhances estate planning. Have I got it in a nutshell?
Yeah, that's spot on.
Great. So let me ask you this. It sounds similar to what people think of as a traditional installment sale. So how does a deferred sales trust differ from an installment sale, and why might it be a better option for people?
Yeah, the collateral, right? So would you like your collateral to be secured against the biggest companies in the world, or these, diversified across, the biggest companies in the world, or some Bitcoin or some passive real estate or some debt, or some stocks, right? Or would you like it tied to the old asset that you sold, which is illiquid, not diversified? And the worst case scenario, and this is the sad story, when business owners, especially, they do an installment sale with the buyer, they
Mm.
think they're retired. Within 2 years later, the whole thing falls apart, and they're having to take big business back and build it back up again, and the value's probably dropped. So traditional installment sales are not attractive
Well,
for
tell
the
people how those work. How does an
yeah, well, because
installment
you just
sale work?
finance the buyer. So if Buck was
Yeah.
selling his business for $10 million and lives in California, right, at zero basis, and Joe wanted to buy his business, Buck can finance Joe. He could become the bank for Joe, and Joe could give $1 million down payment, and Joe and Buck could carry 9 million, and that's a deferral, right? And then Buck only pays tax on the million that he received. Buck could also finance him 100%. And just take interest payments and only pay tax on the interest that he receives. And so that's a traditional installment sale that's very common.
Right. So in this situation, what you're doing is you're basically putting in a third party and getting all the flexibility of potentially being able to invest in other things. So
Yeah, I'll give
once
you an example. We just
yeah,
did a sale out of I'll do the one out in San Diego. They sold basically a $13 million car wash. They built it for 2 million, 4 million, sold it for 13. Massive capital gains tax. Well, we sold right before interest rates jumped up, right? And the problem with the 1031 is you have to buy something of equal or greater value in that same period of time. And so this is a classic example of why the 1031 is broken when markets shift, because now you find yourself with when the music stops, the market shifts and interest rates go up where we're at, and you can lose a lot. And so we're seeing that happen. So instead, they paid off all of their debt. They didn't have to replace any debt. They got
mm-hmm,
diversified, and we started buying Bitcoin. We bought Bitcoin at about 40,000 a coin with one of the clients. Let's start
mm-hmm,
buying these hotels that were going into that were getting hit and hammered. Small pieces of hotels, passive ones. Then we started to put into multifamily debt, making 10% double-digit returns. And in fact, most of the funds stayed liquid or semi-liquid into real estate debt. And then now we're buying stuff at more of a discount, because it takes real estate a couple of years to shift. And what
yeah,
they really wanted to unlock was what's called truly passive income, which kind of goes to your first question, Buck. Well, a lot of our clients want truly passive income. We call that no shoes, no shirt, no problem. The ability to just sit back and have consistent, durable cash flow coming in without having to spend any of your time, your energy, or deal with the toilets, trash, termites, and or just a massive amount of debt that has to be, it's resetting. And so we want to get people, out of debt and get peace of mind. We want to get them out of the active if they want to be, and be able to be passive. And oftentimes you can double and triple their cash on cash return on the return on equity. And so our saying around here, Buck, is that truly passive income is to your freedom and impact, as compounding interest is to your money. And the more and more clients we work with, we find out that's exactly what they want. They want that truly passive income, and they don't want to have to deal with the liability that's associated with active ownership of
mm-hmm.
a lot of their highly appreciated assets.
So when you've got that money inside, you can direct it to effectively invest in pretty much anything. Then, Brent.
Exactly, precisely, and at any time. So any
Mm-hmm.
asset class at any time, and you can also partner with the trust and run your own development project, or buy your own new business venture. And that's the beauty of this. You don't have to be constrained to the 1031 only like kind investment real estate properties.
When you guys do this, I mean, obviously it's going to make a difference, but I mean, how expensive is it? I guess to set up something like this, I mean, and that may determine the level of exit somebody may decide to actually use something like this for. It may not make sense. And then beyond that, if you could comment just on sort of the ongoing costs, like how that works.
Yeah. So you have $1 million net proceeds, $1 million gain to qualify. We found that it's only time really makes sense. It has to be a large enough taxable transaction. So per million on the gross sales price, it's about $15,000 for the one-time legal fee.
Uh-huh.
So let's say it was $1 million sale, to keep it simple, 15,000 at closing. On the ongoing fee, it's based upon the net proceeds. So it's about 1.5 to 2% on a recurring basis. So for every million, it's about 15 to 20,000. Although we cash flow our fees. So being the trustee, that's how we get paid. My business partner gets paid on a legal fee. He gets a one-time fee, covers lifetime audit defense. So we typically will take, for example, Warren and Catherine, $2.5 million sale in California. Their NOI was about 120. We increased their NOI. It's basically 190. Okay. Net of our fees. And so they increased by about 60% on their cash on cash return every year, net of our recurring fees. And part of it because we invest the funds and make excellent returns. And then we wait about 60 days to cash flow our fees, which is something new from our last talk.
So basically what you're saying is rather than just take it off the top, you're participating in the investment and getting paid that way.
It's the trust is paying us, but we're letting the trust pay for itself. The legal fee is one time off the top, so that's gone in the beginning. But the trustee fee, the ongoing fee, we said, how do we more align to help our clients? Well, we align and we get the corpus working. We call it like a plane taking off to get in the air to produce the cash flow. And most clients look at this and they go, wow, I was making 3 to 4 or 5% ROE, especially in California where you're at, Buck, right? On my return on equity. And now I can make, 8, 9, 10, 11, 12% pretty consistently. Durable cash flow that's flowing in. Wow, I just doubled or tripled my cash on cash return and I lowered my liability. I freed up my time and my energy. This is where people go, it's Netflix. Why would I go back to Blockbuster? And we say, yeah, you're right.
Yeah. Now, what kinds of, do you have some kind of advisory within these things that are providing deal flow? Is that kind of how it works?
We consider ourselves real estate investment advisors, Buck, right? So we grew up building real estate in California with my parents in the Bay Area. And then I went to Marcus and Millichap to help people buy and sell investment real estate. And that was before the '08 crash. And then it's when we learned some hard lessons, right? And then on top of that, we bring in amazing specialists, clients have their own financial advisors, right? We try to build like a mini family office, if you think about it, Buck. And so we stay in our lane within real estate and within the deferred sales trust. And then we bring in financial advisors if they want to do stocks, bonds, mutual funds, whatnot. So that's really the key, is bringing in the team members to execute.
And does that cost more for clients?
It's about the same. So it's about 1.5 to 2% on a recurring basis, no matter how and where you invest the funds. So that would include the financial advisor. We probably basically pre-negotiated with them.
Right.
And so it just depends on where the funds go, whether it goes into real estate investments or whether it goes into the stock market. But it's the same cost. It doesn't cost any more to have that financial advisor.
Yeah. Now, with regard to distributions, I presume you can take them anytime you want or not take them at all. Right?
Correct. Well, yes and no. So we do need to have a payment schedule set. It's not something you can never, ever take. So in the beginning, we can delay it for at least 2 years. It's not like a RMD IRA kind of thing, Buck, but it is something where we found through the audits. There's been over 30 audits over all the years. But you're right. One of the ways to make the DST an investment and not an expense is to simply turn it on or turn it off, meaning we can amend the note. And so like someone like yourself, Buck, may have an asset. In fact, I have a client. He's in Sacramento. He has a $14 million apartment complex, zero basis. It's producing about $700,000 of cash flow. Well, because he has no depreciation to offset, he's having to just pay tax on all of that. And so what we can do is we can sell, and we haven't executed this for him yet, but we can sell the $14 million, move it into the deferred sales trust. Then we can delay the payment for at least 2 years. Okay. So we would not only increase his cash on cash from 700,000 to 1.4 million pretty conservatively, but we can delay that 1.4 million at least for a couple of years.
Yeah.
Or he only needs to take a portion of that.
Yeah.
And so this is what we call about income tax deferral compounding return, because really the biggest pain point for taxes is income tax, especially in California, New York, New Jersey. So how do you year in and year out look at income tax deferral? It's the reason why the IRA is so powerful, right? Because they can defer the income tax and the capital gains tax during a period of time. So the same is true with the deferred sales trust. And fast forward to the 2-year mark, he may only need 500,000, and he can let the other amount, the difference between 1.4 and 500, just compound and build up. So you don't have to take the full interest payments ever. We get to say take partial interest payments starting about year 2, but you can also delay it for a couple of years as well.
The trust, the investments within the trust, I presume, are, every time there is activity in there, there's capital gains within there, that it's going to have its own
This is the
taxes.
beauty, Buck. This is the beauty. The trust typically 99.9% of the time never pays any tax. And this is true for all of our trusts. Watch, you ready?
Yeah.
Because the trust can expense the interest on the note that it owes to Buck. So let's walk through a
Hmm.
scenario. Let's say it's a $10 million exit and it has a 10% note. So it's $1 million that's owed to you every year. Plus there's trustee fees, let's say of 150 to 200,000 a year, right? Although it'll be a little bit less than 200 on 10 million. And basically, the trust, that's an expense, and the interest is an expense, regardless if it pays you the out the payment. It files like a C corp tax return on like an accrual method. Okay, it's a business trust that uses it's more like a C corp
Hmm.
how it acts. So every year it can expense the interest even if it hasn't paid you. So it typically operates on like a paper loss year in and
Okay.
year out. Now, is there potential that we out earn so much, like we hit some Nvidia stock or some Bitcoin, and we exit in that year and it's greater than that amount? Yeah, that's possible. And then could it pay tax? It could, right? But that's not unless we exit that piece, right? So watch this. So we typically just cash flow, right? And we try to dial it in at about 8, 9, 10% compounding net of fees cash flow. And the interest rate on the note, and we've written ones as high as 12% as an example, is still expensing every year. So at the trust level, it typically never ever pays tax.
Okay. So say somebody has something like this. Well, let me ask you this too. You said you have to have at some point, after 2 years, you are going to need to take some stuff out. Is there like a minimum the way there are with retirement
Yeah,
withdrawals?
so it's no RMD that's like written into the tax code, but based
Yeah.
upon the audits of which have happened, we found that a good rule of thumb that the attorneys recommend is take about half of the interest starting about year two. So if you
Mm.
had a 10 million at a 10%, which is about $1 million interest per year, you can wait that first year, defer, wait the second year, deferred, third year, take about 500,000. Let the other 500 defer along with the other 2 million you've already deferred, and just do that every year. That's fine. And it didn't seem to be an issue. So yeah.
And presumably at that point, you're paying taxes wherever you are. So if you live in California, but you're planning to move to Nevada in 3 years after the kids are,
Correct.
in college or something like that, then you can just defer it and start really taking your income when there's a significantly better tax situation.
Spot on. We've had clients do that. We had an $8.3 million sale in Palo Alto for the exact
Yeah,
scenario. He had 6 kids. They all moved out.
yeah,
He
yeah.
established this Nevada. Now, the interest, this is important, not the principal. The
Hmm.
interest is based upon the state in which he resides. So the principal is the nexus is still tied to California. So if he ever dipped into the principal, which 99.9% of the clients
Ah,
don't dip into the principal, they just live off the cash flow, which kind of goes back to the original thing. Like, what's the most important thing for your exit? Most of our clients want truly passive income, and they only need to live off some or all of the interest on us in a given certain year, right? We just did an $8 million exit out of Massachusetts for a business owner sale, and they don't need any income for a couple of years, right?
yeah.
Because they're staying on their business. And then when they get their earnout and they retire from their business, right? Because a lot of them do like a 60-40 or an 80-20 exit. Then they have lower income active, and then they turn it on the passive for the trust.
No, let me ask you that, but to drill down on that a little bit, is it because that California client had California real estate, or is
Yes.
it just because the person was located in California? So, for example, if that person had stocks,
That's a
would
good
they still?
question. So it's a good question. So
Yeah,
you're right. If they had Nvidia stock and they lived there and then they moved to, Florida, that's a great question. I would say let's look at that on a personalized basis, but I don't know if
yeah,
we have a really strong opinion on that, but
yeah,
arguably they could make an argument. Same thing with cryptocurrency, that whole thing there too
right.
is an argument there, but you could also make the other argument on
Uh,
that side. So yeah.
okay, so let's talk a little bit about if somebody say at death. Obviously, it's a trust. You could have it in perpetuity and transfer it to somebody, but what if the heirs wanted to decant? What's the process for that? Or is there an
Yeah.
ability to?
Yeah, we have a 1.0 version, a 2.0 version. I'll start with the 1.0. The 1.0, the children can step into your shoes and continue the tax deferral, which is what we believe most will do. So you just add the promissory note to the living trust, and it just, passes like any other asset would to your heirs, however you set that up. That is 1.0. The 2.0, we actually eliminate the estate tax, the death tax. We use a different tax code for that. But this is powerful because the 28 million married and about 14 million
Yep.
single is set to expire in 2026. And so we eliminate the death tax or the estate tax, and the children can be the beneficiaries, and they inherit it estate tax free.
Right.
and capital gains tax free. However, during the lifetime on the 2.0, a part of the payment needs to be principal. So they are going
Mm.
to pay some cap gains tax based upon their life expectancy and
Mm-hmm.
part of it interest. Okay. So we depending on what we're trying to solve for, if you had $100 million exit buck, we would say use the 2.0 at least for 90 million of it. Okay. And let's get that outside of your taxable estate. And the other 10 million would do the 1.0. And so each of them would have their function, but that 90 million could grow to 500 million before you die. And all of that's outside of your taxable estate. And here's the cool thing: no charity, life insurance, or gifting required.
Mm-hmm.
However, you can still leverage it to go and buy life insurance. So the life insurance becomes a gravy payout for the family to make a big impact, however that looks for your
Okay.
family, right?
So how would that, when you say you leverage it, how do you do
Yeah.
that? Like you just buy it from the trust and the families, who's the
So I'll
beneficiary?
actually walk you through. We had a client, okay,
Yeah.
and this is actually a little bit of a new twist in a sense of what we've learned and we've executed. That's really two different things, right? So I had a client, and they actually had an insurance company for 25 years in Orange County, okay, right next to the John Wayne Airport, and they actually owned the building, and so they sold the building. Two business partners, and in fact, his name is Kent. I can share it because he just shared it on my podcast, and you can watch it on my show. So Kent has his 2.5 million. His other partner has the other 2.5 million. Anyways, Kent's like, Brett, I want to do life insurance. Can they trust invest in the life insurance? Well, life insurance is an investment. And the answer is yes. So we formed a joint venture partnership, and we had the trust put up some capital into this LLC, and this LLC purchased the life insurance policy. And we made the beneficiary, the people, the payout or the death benefit, go to this gentleman. Also, the trust needs to get its portion too, right? It's important to keep it commercially reasonable, but it's a joint venture partnership. It's not a loan. Important to understand that. If it was a loan, it'd be taxable. But even so, that joint venture partnership, it owes him the money through the trust, right? So
Mm.
it's a creative way to do this. So yes,
Yeah,
we
it's
can work
interesting.
with life insurance the way we structure it, and it's pretty dynamic.
And okay, so what if somebody really needs to decant? They whatever came up. What's the deal there?
Yeah, the trust can be unwound, and you can pay your tax, right?
Right.
And so we've had scenarios like that where someone's just like, I want to spend it on, my primary home. I want to just go, spend it on personal stuff. Cool. It's cool. Let's just unwind the trust. Let's pay it out. You pay your tax. That's the beauty of it. It can be unwound.
Yeah. Okay. Let's talk a little bit about asset protection. Obviously, it's out of your estate at that
Yes.
point.
Mm-hmm.
So that is a significant benefit there,
On the
right?
2.0, correct. 1.0 is still,
What do you mean by 1.0 and 2.0?
so 1.0, we use IRC 453, which is the traditional installment sale tax reporting method
Mhm.
and strategy, just a seller carryback, right, with the trust.
Mhm.
The 2.0, it's a different type of trust, and it's not using 453. It's something where we would need NDAs to kind of go into more.
I see.
But that version is outside the taxable estate. The other one is the promissory note is inside of your taxable estate, but that can be passed to your heirs. So those just to clarify those two pieces there. That's how
Uh-huh.
that works.
Who's the beneficiary of that trust?
Yeah. So the 2.0, your children can be the beneficiary, right?
Okay.
On the
Uh-huh.
1.0, it's actually it acts like more like a C corp or an S corp. It
Okay.
doesn't
Doesn't
have traditional. It has more like shareholders. It doesn't have traditional
got it.
beneficiaries. It's a business trust. So to make it legal, we need to have a third party unrelated trustee. That's our company, Capital Gains Tax Solutions. So technically, if you said who's the shareholder, it's just Capital Gains Tax Solutions. But the reality is, all of the capital that went in there, plus that, let's say a 10% compounded return, is due to, let's say it was yours, Buck, it's due to you. You're the sole creditor, right?
Uh-huh.
So nothing can be sent or given to the shareholder until Buck has been paid in full.
So, let me ask you this, just as an example. Not probably not now because crypto's way down, but we have a number of listeners who listened to me back in 2017 when I was telling people to buy Bitcoin, and they've done quite well. In those situations, would you potentially just move the Bitcoin? So you'd move the Bitcoin into the trust and then have a massive sale. You've probably had people do that, I'm guessing.
Oh yeah, yeah. We've had now 5 clients exit about 18 million across Bitcoin, Ethereum,
Yeah.
checks, and another coin. So yeah, it's simple, right? In fact,
Yeah.
we open up a Kraken account typically, and then my client, one of them worked for Google, and we exited 5 million at 54,000 a coin. This is before the last run up, so this has been this is
Yeah.
a couple of years back. And then the 5 million was sold from the trust and Kraken to cash, and the cash sent to Schwab. So we did that all within about a 48-hour period. The issue of the promissory note was to the client, so she got a $5 million promissory note. So the money's at Schwab, tax deferred, trust bought and sold for 5 million, so there's no gain. And then she gets payments slowly and pays tax on that. Now, the rest of the story. 54,000 went to about 68, 69, dropped to 15. She held all the way through all of that. Then it came roaring back here in the last 6 months. Hit, I think, the high of about 110. Now we're hovering at 78. But I think, Buck, you're hitting on the nail on the head here. It's so important to understand, if you're a Bitcoin owner or a cryptocurrency owner and you've had massive gains, the beauty of this is the DST was made for the Bitcoin owner, because it's instant liquidity and there's some highs and some lows. Okay. And so watch here, this is like the Monday morning quarterback. What would she have done? And what she would have done, she would have sold everything at 68,000 a coin. That would have been about 70 million of net worth right at that point, right? Everything would have sat at Charles Schwab in a money market account, making 5% or whatever. It would have dropped to 15,000 a coin. We would have just turned around, joint venture partnership, and bought everything in Bitcoin. Not that we would still want to stay diversified. I'm just playing this game out.
No, I get it.
Just to show you what's
Because
possible, right?
it's a very interesting concept, actually, to move into this when you're at some sort of high in Bitcoin, and you think, well, gosh, I might get out now, but I might want to rebuy it, but I don't want to pay a huge
Because the never sellers, they say, I'm never going to sell it. Oh, okay. Or I'm going to move to Puerto Rico to get this tax benefit. Oh, okay. Well, but what if we did both? Well, what if we didn't have to move to Puerto Rico? And what if you could still sell high and then just dollar cost average and buy it back when it hits this lower amount? Even this last run up at 110, had you just sold 25 or 30% of your Bitcoin holding, and let's say you're worth $100 million of Bitcoin, and then we just waited, and every time it dropped to 100,000 a coin or 90,000 or 80,000, like, we have these tranches, and we just put another third back in. And so this is the power of the deferred sales trust, combined with the ability to dollar cost average and still be a buyer of Bitcoin. Like, you don't have to be. It doesn't have to be, most people, it just stops. Their brain stops to think that I should never sell. And if I do, I got the tax. Well, we can do both. We got the best of both worlds here when you combine the team and execute on the plan.
So when you have people, and I'm sure you do, and we're getting into the real weeds here, Brad, so I'm going to ask you questions. We have people who already have trusts and that own the assets, right? Whether that's Bitcoin, whether that's real estate, and so on. How complex does that become? Because the issue is they've already got the asset protection. They've already got the estate planning that they want. However, with these kinds of trusts, you still are going to end up paying the taxes. So have you seen situations where people move from this kind of trust to that kind of trust with a given asset? And what's the complexity there?
Spot on. By the way, the deferred sales trust has asset protection built in automatically, right? So that takes care of that. And then we eliminate the estate tax for that other piece for the 2.0. So we take care of that. So what we've seen oftentimes is, you're right, those strategies stop at the next piece, which is capital gains tax or even income tax deferral or even flexibility with investments. Right. So yeah, we have seen people who already have these other trusts. It doesn't prevent us from helping them at all. But there are times when they go, oh, I didn't even need that had I just talked with you guys first. Okay, to be fair, what are the cons here? You either work with a third-party unrelated trustee, but if you've ever done a 1031 exchange, you've gone through that, or you have an IRA or 401k, there's some third-party custodians, you've gone through that, right? So there are some, you are giving up some controls, I call it, not full control, but controls of the triggers, right? So we have to be on a team here. Why? Because 20, 30, 40, 50% of the wealth is the government's anyways, right? And so we have to play by the rules and keep it commercially reasonable, have a third party unrelated trustee. So that's why you would say, well, why haven't they done it? Because they haven't known about it, or sometimes it's too much for them. They want to just keep it all to themselves, and then you have the pros and cons to all of that. So I just want to answer that for somebody, because they might be thinking, oh, it sounds too good to be true, why wouldn't everybody do it? Well, that is one of the cons. Now I think it's a pro, because you get another set of eyes looking for you and with you, and trying to build this family office approach. I actually look at it as a positive, but each their own, right? They have to decide on that.
Yeah. Yeah, absolutely. Interesting. Yes. Okay, so let's talk a little bit more. I mean, obviously, downsides. There's a downside to everything. Tell me about the downsides, including potential risks, and you may want to address potential IRS challenges and that kind of thing.
Yeah, absolutely. So there's really three major objections or challenges people have before they move forward with this. Number one, legality, right? My CP hasn't heard about it, or is it legal? Is it going to be an audit flag risk now? The answer is it has a close to 30-year track record, thousands and thousands and thousands of transactions, billions and billions and billions of assets over all the years. And there's been about 30 no change audits, state, federal, promoter audits, all no change, no findings. Most of the audits in California. So it has literally a perfect legal track record, which this is why I have such certainty of conviction on this, because I've seen over the years, it just continued to win every single time it's challenged. It has a perfect legal track record. So keep that in mind.
So it has been challenged several times.
Oh, yeah. And that's important, because if it hasn't been challenged, you don't want to just be the first to be the person. Like, you want to say, has it been through the fire of the IRS? And then we've literally sent them everything, right?
Yeah.
And a full formal audit. It wasn't just like state level audit, which had those.
So you've had the audits. You guys have already had audits?
Yeah.
Okay, that's
all
great.
the audits.
That's great. Okay.
And no change, no findings. This is important, right? So that means it's like literally like they couldn't find one thing to change. And so if Buck or I or anyone who's listening has had a audit on their tax returns, they're going to find a receipt that Buck missed or I missed or something. And they're going to say, hey, you owe us a little bit more or something there. But they said no changes. And so we have a perfect legal track record. That's number one. Number two is controls, right? And the third party unrelated trustee, right? You've got to be able to trust the trustee, our team. And by the way, we invest with folks like Buck Joffrey, right? We invest with folks like DLP Capital and folks like Mr. David Young, who helped build PIMCO from 80 billion to 1.2 trillion. He manages some of the biggest wealth in the world. So it's not just trusting just us. It's looking at the team to execute the business plan.
And by the way, though, you get to choose that too. It's not like, I mean, you're providing options,
right?
And so I think that's the key element.
Yeah, and if Buck had his financial advisor he wants to bring in that he's had for 25 years, great. He'll manage the capital, right? That's fantastic. And our role is the trustee. Buck is the note holder, and we're a team that executes the plan, and that's the key. Right. We can customize this to your liking, right? And your comfort level. So that's the second one. So the third one would be fees, right? The DST has got to be an investment, not an expense. And we've got to figure out ways to get new depreciation schedules, which we'll show you how to do with the trust, how to defer the income tax. We've already talked about that. How to eliminate the estate tax. We've already talked about that. And of course, defer the capital gains taxes. And you add up all of these these ROIs, and you go 1.5% to 2% as a deal. Like, it's not even close, right? It's not even close. But at first, if someone just says, wait, am I paying how much? Well, this is something that's very special, and it takes a full team to execute. Now, we're the offensive coordinator to get it all seamless and turnkey and truly passive for you. And that is the key, that, how we earn what we earn. And so once people understand those three, I say the big domino falls, and they say, gosh, Brett, thank you. Like, this isn't transformational for our families. Of course, we have all the client deal stories. You can go talk to the clients and, just don't hear it from me. We have amazing people that will share the story with us.
Well, and just, the other thing that comes to mind is there are options here too. Like, I was just thinking what the lengths that people go to with cryptocurrency in particular, like moving to Puerto Rico. Well, maybe you do this until you decide, okay, it's time for me to move to Puerto Rico for a year. And at that point, you know exactly how much money you have, instead of hoping that during that year in Puerto Rico, your Bitcoin doesn't go down by 50%.
Exactly. You nailed it.
And then you decant in Puerto Rico, knowing exactly how much you have after a year.
And then it seems like Puerto Rico, and you get island fever, you want to go home, and just throw your hands up, right? Like, that's the whole point. That's the same thing. The client from Google, she stayed in San Jose. That was her family. That was where she was at. She's like, I want to go to Puerto Rico. Let's just do this and be done.
Well, and then, to be clear, though, I mean, theoretically, and again, maybe this is too complex to just say offhand, but if you wanted to later decant and you were like, I'm willing to be in Puerto Rico for a year and then I'll decant, you could do that. And then you prove in that case, you probably wouldn't have to pay the tax. You'd pay Puerto Rico tax.
Yeah, check with your CPA, but that sounds pretty good to me, Muck. You know?
Anyway, yeah, this stuff always gets my wheels turning. So it's kind
Yeah.
of funny.
Well, there's 84 trillion transferred in the next 15 years here. 84 to 100 trillion baby boomers, largest wealth transfer history of the planet. And we're on the front lines, like the battle. Like we've seen the last 60, 90 days here with the government's being, the Doge is uncovering here. This is brutal, right? It's not just like defer taxes for me and my family. It's like stop the waste, fraud, and abuse, and like, giving the drunk another drink, right? It's like, this is a travesty what's happening with American tax dollar. And so we want to see it in the hands of the people to be able to build multifamily housing, to end the housing crisis, right? To be able to give the most vulnerable people, to make a difference and hold people accountable for it, create more jobs, which creates more tax revenue. So this is what it's about. Like, how do we unlock this capital to multiply freedom and impact? But it takes all of us to understand what our options are and then getting the word out like we're doing now. And then you as the listener, if this is you, bring in your CPA, bring in that person who may not know about this. Let us educate and work with them. Let's add to the team a new tax attorney, a new trustee, a new CPA group, but also keep your existing one, and we'll just build on the team, right? We'll build on the team, and then we'll execute the strategy. So that's really the biggest thing.
Yeah. One more question. What if people have multiple assets? Can they decant into the same DST over time? So
Correct.
They're basically building that? Okay.
Yeah. So you can have one trust and 10 different exits and 10 different, asset types. The only difference is the only time you have two trusts, if you're over that, basically that $20 to $30 million mark in net worth, then we've got to just really plan for eliminating that estate tax. But oftentimes we'll do the first 10 million, at least each calendar year, into the 1.0. And then on the 2.0 for anything above that, like we're working on a $250 million exit for our client, we'll do 10 million on that first tranche, and then the other 240 into this DST 2.0, just to forever eliminate the estate tax. And this gentleman, he's in his mid 30s. He has massive exit, and that easily can turn into multiple billions over his lifetime. And that's the ability. It's all forever outside the taxable state. Never any life insurance or gifting. It doesn't take away any of his gifting or insurance required. And that we build it right at the exit. And that's the key here. If you're looking at this, we need to set it up prior to the close of escrow. Really important. We've got to get the language into the contract to give you the option to work with this. And the last thing I want to leave with people about is the best 1031 exit plan. We just released that actually. We've been doing it for a while, but we're really trying to educate people that you don't want to get caught with a 1031 exchange accommodator that doesn't allow you to also use the deferred sales trust. Okay. And so it's really important that you set up your 1031 with us before. We work with one of the best accommodators in the entire country. And then we'll weave into the language where you can do a regular 1031. Great. We all power to you. You found the deal. Or a deferred sales trust in case it fails. It's so important. Well, the last version is you do a partial 1031 and a partial deferred sales trust.
I see.
This is so important to understand the difference, where you never want to go into a 1031 where they lock your handcuff jail. Like there's some big companies out there that just put you in 1031 jail, and you have no option for the deferred sales trust. Those are the worst calls. So make sure you get our best 1031 exit plan.
Anyway, very interesting stuff. I appreciate your time today, Brett. What's the podcast called again?
So we actually have two. So we have Capital Gains Tax Solutions, and then we have the Build It to Billions podcast. And our tagline is so you can give more, all of it away. So those are the two best places. And then we have the book too with Kevin Harrington from Shark Tank. If you want to check that out, that's on Amazon. It's called Building a Capital Gains Tax Exit Plan.
Fantastic. Thanks again for being on. Always a pleasure.
Thanks, Buck.
Be right back. Welcome back to the show, everyone. Hope you enjoyed it. Mel. I think it's a very interesting idea. And one of the things I kept thinking about was like, a lot of these people who end up moving to Puerto Rico, like Tika Dewari and some of these folks with lots of Bitcoin, that's not something that everybody can do. And so, gosh, one thought is, could you, effectively just, if you wanted to sell when numbers are really high and then, keep it in a DST until you can move to Puerto Rico for a year or something like that, and live off of it and then not worry about the rug being pulled out underneath you. That's certainly something to think about. Presumably that's something you'd want to talk to with your tax your tax professional. So don't take my word for it, but it's certainly, I don't see any reason why it wouldn't work. Anyway, that's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.